Respected Chairperson Sir, eminent speakers for the day, distinguished dignitaries, senior officials of NAFRA, and ladies and gentlemen, a very good afternoon to everyone. I am very pleased to welcome you all on this second day of webinar series being organized by NAFRA as a part of celebration for Azadi ka Amrit Mahotsav. Yesterday had been a very enlightening day with the two technical sessions by CA Vidyadhar Kulkarni and Professor R. Narayan Swamy. Before we begin with the two technical sessions scheduled for the day, I would like to invite Shri Rakesh Bhanot, Executive Director, NAFRA, his welcome address and opening remarks. Shri Rakesh Bhanot has served at various levels in SEBI for more than 15 years and in Competition Commission of India for about a decade. I'll now request Sir for the welcome address.
Thanks, Swati. Welcome to the second webinar that NFRA is hosting this week as part of 75th year of Independence Celebrations of India. We've had two excellent sessions yesterday by Professor Narayan Swamy and Shri V.C. Kulkarni, Senior Consultant at NFRA, which were preceded by opening remarks by the Chairperson, NFRA. Topics today are the role and responsibility of auditors under the Companies Act and consideration of fraud in financial statement audit. The role of auditor is increasingly coming under greater scrutiny. Almost every week we read in some newspaper about the work of an auditor in a context sometimes that is not so pleasant. As we are a market economy and money is being raised from investors every day and put to use in business, investors need an assurance that the financial statements presented to them are not misleading in any manner. An auditor's role is to confirm compliance with the accounting standards by the preparers by performing audit as per standards of auditing laid down. Besides these, there are several laws and regulations which guide them in the audit. One of the relevant auditing standards is SA 250, which deals with the consideration of laws and regulations in audit of financial statements. The auditors also have to abide by the Code of Ethics issue. Companies Act 2013 is one of the key laws that governs the corporate sector. It is therefore important for the auditors to work within the framework of this law and ensure compliance with regard to prescribed matters regarding their audit work. In this regard, I look forward to the talk by Shri Suhas Tuljapurkar, who is a well-known legal expert and also a member of the Technical Advisory Committee of NFRA. His talk would also be very useful for members of the profession, users and preparers of financial statements, students and academia. Auditors are always in the spotlight when something adverse happens. And of late, we have seen a number of instances where companies' true financial picture has not been revealed despite robust audit requirements. This has happened internationally as well as in India. Recent examples are Carillon, Wirecard globally, and India, ILFS, Diwan Housing, etc. I'm not saying it always happens with the connivance of auditors with management, but auditors do have onerous responsibilities in discharging this role in the audit assignment. These are guiding principles like auditing standards. There are guiding principles like auditing standards, standards of auditing, laws, code of ethics for auditors. Specifically with regard to fraud, auditing standards SA 240, auditor's responsibility relating to fraud in an audit of financial statement is important. However, with the evolution of business into e-commerce, faceless banking, and increasing use of software like ERP in accounting, the audit needs to be much more expensive and detailed so that auditors are not misled into giving a clean sheet to a company which does not deserve it. In this regard, the talk by Ms. Vidya Rajarao, who specializes in forensic audit and is a member of the Technical Advisory Committee of NFRA, becomes relevant since she will be covering the topic fraud in a financial statement audit. I thank both the speakers for their willingness to come and share their views, and I would like all participants to listen with interest to the learned speakers and benefit from their insight. I hand it over back to Swati for conducting the rest of the proceedings. Thank you.
Thank you, sir, for your words of wisdom. You have most aptly set the stage for the technical sessions of the day. Ladies and gentlemen, let us now begin with the two technical sessions. It may kindly be noted that the views presented by the speakers are personal in nature and does not reflect the views of NAFRA in any manner. Each technical session would be followed by the question answer session. The questions may be submitted by clicking on the tab Submit Your Query on your screens, as the time allotted for the question answer session is limited. Only a selected questions would be answered by the speaker. Now, let us begin with the first technical session of the day, that is, Auditor's Role and Responsibility under Companies Act. I extend my warm welcome to the speaker of this session, Shri Suhas Tuljapurkar. Mr. Suhas is an esteemed lawyer with over 37 years of experience. He acts as an independent advisor to various companies, governments, trade associations, professionals, celebrities, non-profit entities, and so on. He is passionate about legal innovation, legal technologies, application of game theory to complex legal problems, and demystifying the laws. He is founder director of Legacy Services Private Limited and currently serving as the member of Technical Advisory Committee of NAFRA. Now, I hand over the platform to Mr. Tuljapurkar for his session.
Thank you very much, Swati ji. Thanks a lot, ED Sarji. Thank you, Vidya Kulkarni, the entire team at NAFRA. Very grateful for you to give me this opportunity to share my views. I'm going to kind of give a small presentation, and during the presentation, try to explain a few of the elements, because I think to expect that in about an hour's time to talk about auditor's role under the Companies Act would become a very difficult and onerous task. So please pardon me if I have left out few of the things, if I kind of not able to present the entire scenario with respect to the role of auditors under the Companies Act. Is my screen visible?
Yes, sir, it is visible.
Yeah, okay. Thank you. Thank you very much. So thanks a lot to Professor Dr. Narayan Swamy, Shri Ashok Kumar Gupta ji, and my fellow colleagues on the Technical Advisory Committee. Ms. Vidya Rao, she will be speaking about fraud, and I don't want to take our thunder away today. I will briefly touch upon the elements of fraud under the Companies Act. Thanks a lot to Mr. Vidyadhar Kulkarni. Before I proceed further with the agenda, I just want to kind of lay down today. You see, the auditor ought to be looked at, and I think that's a perspective that's all across today. Auditor is a fiduciary in nature. So while few of the thought processes would be around to say that auditor needs to take care of or focus himself or herself on the stakeholder that engages the auditor, which is either the company or the individual or any of the stakeholders, including the stakeholders at the company level or the shareholders who appoint the auditor eventually. I think they need to look at shareholders as a stakeholder and be far more accountable to the stakeholder. I think that rule is getting vitiated completely. I will touch upon why we say that. We'll look at few of the provisions of the Companies Act to see at a 360 degrees what all does the Companies Act do, especially with respect to the statutory auditor. I would like to focus a bit upon the liabilities angle and the liabilities related provisions. I'll also want to see that beyond Companies Act 2030, how the fraud and the elements of fraud are to be looked at. Finally, we'll look at the sinking relationships with the auditor in light of the Companies Act 2013 provisions and thereafter. We'll also look at few of the elements that are bothering the profession today in terms of saying where is this gravy train that the auditors would want to go after. But before we do that, I just wanted to kind of express a gratitude to all the frontliners, gratitude and many, many thanks to freedom fighters, defense personnel, and martyrs who laid down their lives for India's freedom movement and thereafter in protecting us. During the COVID period, the healthcare experts and the law enforcement officers, a big thank you to each one of them for keeping us safe and, and keeping us healthy. No words can express our gratitude to all these professionals. We are all indebted to you. Thank you very much. On the occasions of this Azadi ka Amrit Mahotsav, I would like to express this on behalf of all the professionals that are in the corporate sector today. Of course, the caveats, and I think Swatiji, you touched upon it. I want to make sure that this is only for general awareness of the subject matter, which is the role of the auditors today. Nothing here constitutes a legal opinion. Secondly, I think the statutory and regulatory ecosystem is so dynamic that it keeps changing. A risk that I identify during this presentation or during this webinar may not remain a risk tomorrow, or there may be some risks that will get added or identified, and I think the entire landscape will change. On a couple of elements, I'm going to do what I call as eagle's eye view approach. We will go in depth only on those two, but I think this webinar doesn't deal exhaustively with the subject matter. And of course, the views that would be expressed are my personal views. They are not views of my organization, Ligasis, nor are they views of NAFRA. So with that caveat, I want to look at the fiduciary nature of the auditor. And you will find it as a statutory provisions all across under the Companies Act. You see, when we talk about auditor, you see, it's a noble profession at one level, where they're saying the most trusted professional in the corporate sector today is the auditor. Also, there is a complete ethical dilemma today in terms of saying that if I have been appointed by the shareholders of the committee of the company, or I have been appointed by, let's say, to do audit by the Audit and Risk Committee under the Board of Directors mandate or delegated by the Board of Directors. So if I'm appointed by the board, if I'm appointed by the shareholders, which constituency do I represent? And from that perspective, this ethical dilemma starts kind of becoming a conundrum as we move forward. Because at one level, whatever an auditor does, the Companies Act looks at it to say that there is a fiduciary duty. There is a fiduciary duty, and within this fiduciary duty comes in four independent aspects. The first aspect is that of a conflict of interest, or let's say what we call as duty of loyalty. And this duty of loyalty, the first fiduciary duty for any professional, and especially the auditor, is duty of loyalty to the company, duty of loyalty not only to the shareholders. And therefore, when you say duty of loyalty, fiduciary duty of loyalty, it is to all the stakeholders of the company and to act in the interest of the company per se. Within this will come in various elements such as related party transaction, conflict of interest, and host of other elements which have found place in the under the Companies Act in terms of various provisions of law. But this fiduciary duty is the most critical element, and this duty of loyalty to the company becomes a very important aspect. We have seen at many a times the auditor becomes the fall guy. And I think whenever I've discussed a few of the issues with the auditors, they believe that since they signed the accounts or financial statements, they believe every blame will be fastened onto them by the management, by the shareholder, by the regulator, by everybody. The blame will be fastened onto the auditor, and auditor would become a fall guy. It is in that context we look at the second fiduciary duty, which is duty of care. And that duty of care goes down to looking at micro level items, the line items that are required to be checked, reviewed, audited, and that becomes duty of care. Another area of focus all across under the Companies Act is the public interest element that gets fastened on to the responsibility, duty, and the role of the auditor under the Companies Act. And by and large, when the companies, which are listed companies or companies where there is a public interest, the issue about the public interest, actually, the courts have proactively increased the scope and the depth of the definition of what amounts public interest. Public deposits, obviously, public holdings, obviously, listed companies, even unlisted companies where there are public deposits, even unlisted companies where there are lenders, secured lenders who have kind of lent large amount of money. There is an element of public interest that comes in there. And to that effect, this is not only limited to the listed entities. Of course, it is in the forefront when it comes to listed entities, but it is by and large the interest of the stakeholders, the interest of the public at the core. Duty of extra care, which is again a very critical element. When you see something which is not really the normal course of the things. When you look at M&A kind of transactions, when you look at any of the risk-related items that are part of the enterprise level risk management, I think the duty is cast upon the auditors under the Companies Act to take or to be extra careful in analyzing, to be extra careful in looking, reviewing, and auditing those things. And fundamentally, I think all across the Companies Act, and when we talk about it, when we look at the prosecutions, when we look at the litigation or prosecution related risk, it is very critical that at every step, the auditor is in a position to demonstrate that he is acting in good faith. So the auditor becomes a fiduciary. The auditor is the fiduciary, which is going beyond the mandate that he carries. We have seen many a times the auditors come back to say that, fine, this is the mandate given and I have acted within the four corners of the mandate. But the law goes beyond that mandate, beyond that contract between auditee and auditor. It would look at the fiduciary aspects of the role of auditor. It would look at all these elements, including whether the auditor acted in good faith or not. And I think, therefore, when we talk about the role, responsibilities, statutory liabilities, regulatory oversight, as also prosecutable risk, I think all these elements which go on to demonstrate the good faith, it becomes very, very critical. If you look at the 360 degrees view of auditors under the Companies Act and the way the things dynamically get amended from time to time, it becomes very, very critical for every auditor to understand the changes in the laws that are happening. And from that perspective, when we keep Companies Act 2013 at the focus, right from appointment of the auditor, the reappointment, to its resignation or removal, I think all of these elements dovetailed into various statutory and regulatory provisions. I'm not going to kind of get into the sections and the rules because that anybody can read and look at it. All I'm trying to kind of impress upon here is that anything and everything that you do today, qua a company as an auditor, I think there is a 360-degree connect. So each and every element or sub-element of what you do at the company's level is interlinked in such a manner and fashion that everything gets affected. So to that effect, I think 360-degree view in whatever you are doing, whether you are only merely certifying a particular element, or whether you are kind of conducting a tax audit, or whether you are conducting an internal audit, or whether you are conducting a limited compliance audit. You see, you will have to realize from the point of view of Companies Act that the various provisions are intertwined in such a manner that it becomes very, very important that in whatever one does, one has to look at and one has to consider the entire lay of the land or entire lay under the Companies Act and the rules. You see, I'm going to kind of do a bit of deep dive on a couple of provisions, which is 147.1. which clearly says that, you see, if the auditor contravenes the provisions of 139, 143, 144, 145, the auditor shall be punishable with a fine which shall not be less than 25,000, but which may extend to 5 lakh rupees, or 4 times the remuneration of the auditor, whichever is less. Provided if an auditor has contravened such provisions knowingly. Now, therefore, many a times, I think people or the auditors come to us as lawyers to say that, no, but I was not aware about something that happened. You see, as I said, duty of care and duty of extra care needs to be demonstrated. If you have done something knowingly or knowingly you have not done, in a sense, you have act of commission or act of omission with the knowledge and with the willful intention to deceive. Now, deceive the company, shareholders, creditors, or tax authorities. It shall be punishable with an imprisonment for a term which may extend up to 1 year, and fine which is not less than 50,000 rupees or may extend to 25 lakhs or 8 times the remuneration of the auditor, whichever is less. Now, therefore, when we talk about roles, responsibilities, I think first I'm going to focus on saying what is your liability and realize this. So, mens rea, whenever happens, I mean, in a sense, many times auditors come to us to say that, hey, but we were not aware about what was happening at the management level. We were not knowing that these things are happening. We had no knowledge. We had no mens rea. And therefore, why should we be liable? Why should we be prosecuted? Etc. etc. I think the logic, defeats the statutory provisions under the Companies Act, and to that effect, under the common law, under the criminal jurisprudence, it may probably be a defense to you. I'm currently revalidated by the 2 recent Supreme Court judgments to say that you will have to demonstrate mens rea prima facie. However, if there is no mens rea, that does not mean that there is no liability or that you have not contravened the provisions of the Act. So that's 147(1) from the liability of the auditor's perspective. Now, if he is convicted for more than 2 times, then what happens? He has to refund the remuneration received by him and pay the damages to the company, statutory bodies or authorities, or to members or creditors of the company for loss arising out of incorrect, misleading statements of the particulars made in his audit report. Now, here is the tort-related provisions getting into statutory provisions and occupying the space of a statutory damages being levied. This is a very interesting element. See, whenever we talked about fiduciary responsibility and fiduciary liabilities, it always was a tortious claim. The entrustment, which kind of gives rise to the fiduciary duties, is in the realm of torts, whereas payment of damages was in the realm of torts. What does Company Act 2013 do? Is not only contravention that you will pay back remuneration. If this contravention and this has been convicted, you will pay damages. Now, damages to be paid to the company, statutory body or authorities or shareholders or the creditors of the company for loss arising out of incorrect or misleading statements. Now, this is a very, very wide provision today. And many a times we have realized that the damages element is subdued somewhere. Now, let's look at this statutory provision and a mandate letter that auditor executes for every mandate. If you look at that, you cap your liability there. You say to the company that as a matter of contract, I am saying my liability is not going to be more than the fees I receive or more than 2x of the fees I receive and things like that. So you will probably contractually try to limit your liability under the contract. But here is the statutory provision under 147(3). The statutory provision will over contract provisions in all respect unless the Act allows you and Companies Act does not allow you to contract out of the provisions of Companies Act. And therefore, to that effect, your mandate letters may be talking about limiting your liability and damages, but your obligation or your liability under the Companies Act to pay damages would be over and above the mandate letter arrangement that you have. Because, again, go back to the fiduciary responsibility or the fiduciary nature of auditor. You are saying that my mandate letter is with the company or with the shareholders of the company, whereas as a matter of your conviction or post-conviction, as a matter of your misleading statement or incorrect statement, the other stakeholders in the company are getting adversely affected or are being put to loss, and therefore the damages are arising out of that loss that arises there. 147.5, again, one of the critical provisions. See, very clearly the fraud takes a center stage today. I think thanks to Enron and the various kind of scams or failures or frauds that happened at the corporate level, I think today under the Companies Act, when you talk about the auditors, and again, I'm saying I don't want to kind of take away thunder from Vidya ma'am, but if the auditor or the audit firm is acted in a or abetted and collaborated in any fraud, okay, then there is a liability that gets fastened to the partner and the firm. In case of only criminal liability, the liability will devolve on the concerned partner or partners who acted in fraudulent manner, but the pecuniary liability, damages or pecuniary elements of the liability will get fastened onto the firm that you represent. So this is broadly the auditor's liability. I'm not going to touch upon punishment for fraud for paucity of time. I'm going to kind of look at frauds, auditors' reporting requirements. Now, when you talk about fraud, I think very briefly I want to touch upon to say that, the enforcement and intelligence agencies today are active, they are vigilant, and therefore you need to be very, very wary about any allegations of fraud, that allegations of misstatement that emerge, because the preliminary inquiry stage, and this is coming out of an empirical evidence today, the preliminary inquiry and investigation stage takes about 3 years. Now, under the Companies Act, SFIO has been vested with the exclusive powers to investigate, to take care of anything that touches upon the subject matter under the Companies Act. So to that effect, I think 3 years is the preliminary inquiry. Then there is a trial which goes up to first level and second level and up to Supreme Court. It takes nearly 15 to 16 years for that that matter to travel across and come to finality. This is the reason why when there is even a letter of F in fraud that you see, misstatement in the accounts that you believe, and if you are not able to demonstrate good faith, what is it that you need to do under the Companies Act to demonstrate that good faith becomes very, very critical, because good part of your career will simply get wasted here. Is resignation an option? Is quitting an option today? I think reporting concern, because many times this is another area where I think if the auditor is not otherwise disqualified, he can actually resign. He can actually resign and disturb the status quo. You see, therefore, is this an option today? Is resignation an option for the auditors? In my view, no. It actually kind of demonstrates and ensures that till your resignation, your liability would be fastened onto you. And none of these corporate actions that lead on to the fraud can actually happen overnight or in a short span of time. So therefore, to that effect, I don't see this as an option. Quitting is an option. Overall, considering the current situation in the corporate sector today, I think the relationship, which is probably the relationship of a trust with the auditor, is completely changing. In these changing times, if you were to look at Companies Act prompted and how it has kind of pivoted, why very broadly I call it as an access filter, is because you see, there is no longer a reliance on the auditor by the auditee entity. Neither are the third parties nor are the public at large is placing a reliance on the audit reports or auditors' output today. Auditors believe they are from this earth and the entities are somewhere in. They would have imaginary kind of claims to be brought in. They would have various elements in their financial statements which are not really down to earth. And therefore, to that effect, whether the auditor relies on the management representations or the public at large relies on the auditor's report and deliverables, I think there is a huge gap today. There is loss of reliance that has happened. And to that effect, the relationship is sinking. The relationship between the auditors and the promoters, you see, very clearly. I mean, I was talking to one of the auditors, very senior partner of a large firm. He said, "See, we are here in India and we will continue to remain in India. These promoters today, they can just go abroad. So I'm stuck here in India, and therefore I cannot trust whatever promoter says in any." To that effect, the earlier regime actually had an element of trust between promoters and auditors. I think there is a loss of trust there. CFOs and auditors, the CFOs believe that they're owners of the financial statement. Now, look at the Companies Act related provision, look at the MR. CFOs believe that the auditors are their supervisors. They only will have look at few of the samples. They will not do 100% assurance. Whereas the management and the promoters would want from CFO 100% assurance. The gap between 100% assurance and the audit, or the auditors acting as advisors, is leading to loss of confidence between these two critical players who are supposed to act in consonance with each other. Auditors versus general counsels, you see, general counsels are privileged. In a sense, under the provisions of the Companies Act, you have a legal advisor's privilege which will get fastened on to the general counsel. The same privilege is not applicable to the auditors. It's only the bankers and the legal advisors who have been provided with that privilege, where their advice will not be questioned. Whereas the advice given by the auditor will always be subjected as an expert advice, liable for damages in a class action suit in a much more manner, and a far too greater importance would be given to the opinion or advice given by the auditor. So this is, with the changing times, I think these relationships are sinking. Now, is this a chicken shit club? Because in a sense, are the auditors we would reach today? And I think that's one thing which Companies Act kind of completely changed. You see, this was right from US Department of Justice onwards, where they said under SEC provisions, auditors claim privileged. Auditors claim to be professional advisors, and therefore there was an era where the auditors stood away from the prosecution, and I think that the Department of Justice didn't kind of prosecute auditors at right, left, and center. But I think those things have changed, and I think Companies Act has actually pushed this across. So to that effect, I think it's moving profession from being a complice to an accused in the eventualities of the fraud and in the eventualities of criminal liability is an important element. Earlier it was 120B of IPC, where you were a complice, you were aiding and abetting in the offense. Today, with these statutory provisions, I think the auditor becomes co-accused along with the main accused, or at times becomes main accused. Also, I think the relationship in terms of professional negligence has moved from being professional to an expert. And as I pointed out, with an expert, the damages get fastened onto them. It's no longer on of reliance on the management representation that will save an auditor. Is an honest advisor to owner. I think it's no longer a privileged role. Therefore, whatever advice that you're giving, you will have to own that advice as though it's your own and as though you are giving it to yourself. This is statutory liabilities. Again, moving from back end to the front end is what's happening. So the auditor's gravy train today, and this is where the non-audit service element comes in, where, there are non-audit services and there are other services which are possible with the approval of the board and audit. If we look at the fiduciary responsibility and fiduciary duty of the auditors under the Companies Act and various provisions of the Companies Act, you will have to really look at to say that independence of auditor comes to the forefront. And in that situation, by providing non-audit services, by providing, Swatiji, are we running out of time?
We have 15 minutes to go for your presentation.
Which is fine. Okay, so this is probably the last slide that I'm going to present. Thank you. So non-audit services point of view is an area where there are completely prohibited NAS, prohibited non-audit services that a statutory auditor cannot render. Now, if you were to look at some of these elements in here, you're saying accounting and bookkeeping related services you cannot provide because this would end up compromising your independence in terms of your role as a statutory auditor. You cannot provide internal audit. You cannot design and implement financial information system. So I think when it comes to talking about the controls and talking about the corporate financial systems, the auditor ought to be away from designing and implementing the financial information system. Actuarial services, investment advisory, investment banking, rendering outsourced financial services, management services. This is a broad term. And therefore, I think it needs at some point in time an elaboration in terms of what are these management services. I think we can actually look at what's happening in EU and focus on what are these non-audit services which are prohibited non-audit services falling under the category of management services, or any other kind of services as may be prescribed. We didn't see any prescription as yet. So the non-audit services or prohibited non-audit services is one bundle where the statutory auditor cannot render any service. Now look at the category which is open. And the category that is open is all other services possible with the approval of the board and the audit committee. This is where I think the gravy train appears. While the restricted list of prohibited AKAM is specific, except the management services is a broad category, you have all other services which are possible to be rendered by statutory auditor with the approval of the board and audit and risk committee. So these are regulated items, so to speak. If the company believes, if the board believes, or if the audit and risk committee believes that providing these services by statutory auditor will compromise the independence of the auditor, then the call is on the board and the audit and risk committee. It is from that perspective that then the onus shifts back onto the board and the audit and risk committee. However, in my personal view, I am saying if you're a statutory auditor, you should not render any other services, because anything that you do for that particular company is going to kind of question or compromise your ability to provide independence to the fiduciary duties that you are required to discharge. This is one of the critical areas under the Companies Act. If we beef this up correctly, and I think not only that the quality of audit will improve, but the enabling provisions in the Companies Act would make sure that the roles, responsibilities get a better clarity. However, when you talk to auditors, I think they believe that they're not being compensated enough for the audit services that they provide. And this is where the risk and reward kind of an element comes into picture. While the risks relating to the liabilities, duties, roles and responsibilities are higher, the amount of statutory audit fees that an auditor gets, he always believes that they are not commensurate with the risks that he carries, and therefore risks and reward needs to be set on the side of the audit services. It is this imbalance in the risk and reward, or perception of imbalance in risk and reward, that pushes an auditor to look at finding faults with the definition of prohibited non-audit services, or make himself move to enlarge his scope to kind of try and get more certification related matters. Now, that's again an area where once a certification is provided by an auditor under the Companies Act, read with the provisions of the Indian Penal Code, that becomes a statement which is given to the public about the authenticity, accuracy, correctness, exhaustiveness of that subject matter which is being certified. And there, providing an independent certification from the auditor again gives rise to the responsibilities and liabilities, not only under the Companies Act, but they transgress into other legislative provisions. You see, when we talk about other legislations, I think we have to realize one thing. There are 35 legislations that apply to auditor and audit firm. In India, if you look at it, there are 35 legislations that apply. Besides this, there are 136 standards and guidelines that apply. Now, functioning with 35 legislation, 136 standards and guidelines itself gives rise to being on the top of multiple tasks at micro level while you are preparing, or while you are reviewing the financial statements, while you are auditing the financial statements, and while you are signing off on the financial statements. This conundrum, now coupled with the digital explosion, is kind of creating a huge gap today between what the law intends to do and what's happening at the ground level. With this, I'm going to kind of stop here. There are various elements that one can discuss, talk about, but I thought of focusing on few of these elements and areas so that we are able to, discuss few of these elements. Please feel free to ask any questions.
Thank you, sir.
Thank you very much once again to everybody.
Thank you, sir, for your session. We have come a few questions from the audience. I'll read out the questions for you.
Sure.
Is auditor liable only under section 147, or whether section 447 or 448 are also applicable to him?
Yes, 447, 448 are also applicable to him. All the residual provisions under the Companies Act where one could be held liable and responsible are also applicable. Yes, I think it's not limited only to one or two sections.
The next question which has come to us is acronym "the fall guy" is used in the presentation. Whether in today's world the auditor actually fits to be called as fall guy or not.
Sorry, I didn't get that. Fall guy? Yeah, I think.
You have used
auditors. Yeah. Sorry, Swatiji, I followed. It's the fall guy expression.
Sorry, I was just restating the question. Please continue.
Yeah, please, sorry. So I think the auditors believe that they are the fall guys. I can kind of give umpteen number of examples where the auditors come to us to say that, hey, we made a mistake. Okay, we didn't check into the details. Correct, but I had no intention to defraud anybody. But now I am facing this debarment, or I am facing prosecution, where management is saying, I trusted the auditor and therefore auditor is responsible. Independent directors are stating auditors ought to have done their own analysis, whether or otherwise. before advising us onto something. And therefore, earlier what used to happen is this advice was in the nature of advice. Today, it needs to be owned under the Companies Act. And therefore, from that perspective, I think they are saying if there is a fraud that happens, by its nature, the fraud is supposed to be undetectable. However, what is expected is that auditors should actually look at elephant in the room and focus on how do you address these elements at a micro level. So to that effect, the auditors believe that they are being made a fall guy. It is in that context that I used, the fall guy terminology. And mind you, there are instances where genuinely auditor had nothing to do, but has been caught in the rigmarole and is being made a fall guy. Does that answer the question, Swati?
Yes, sir.
Okay.
We have a kind of related question, whether in today's world, the auditing profession given notion of noble profession is still valid.
Sir, very difficult to answer this question because when we talk about noble profession, I think very interestingly, it may still serve to be a noble profession, depends on how the professionals behave, how the professionals work within the ethical culture. You see, today, if you look at it, and I'm sure Professor Narayan Swamy talked about the culture and creating a culture which is that of a trust, a culture where I think ethics come to the forefront. And I think if the auditor as a professional kind of creates that ethical atmosphere and ecosystem, it would be no doubt a very noble profession. Because in the corporate sector today, and add to this the digital explosion that has happened and accelerated because of COVID, you see, who do you rely upon? In today's circumstances, if I'm a small shareholder in a company, in a large listed company, who do I rely upon? Whose statement do I rely upon? Everybody has various caveats and disclaimers. If I can rely on somebody out of all this, I think that would be the auditor. And from that perspective, I think it could still be a noble profession. Under today's challenges, I think, and this would largely depend on the individual professionals or a group of professionals, but it could still emerge as a noble profession amongst those various elements in the corporate sector today, where the individual small shareholders, small investors, and stakeholders who do not have ability at a large level to make an impact. If the small stakeholders can rely on somebody, they can rely on this noble guy called auditor.
Thank you, sir. The next question we have got is, do you consider that companies should be held responsible if later out of investigations it is proved that auditors provided prohibited services, since the company itself is the ultimate approver of that service?
No, if there is a prohibited non-audit service that is kind of given by the statutory auditor, I think it needs to be taken very, very seriously. And the auditors need to be taken to the hilt. That's for sure. If, for example, knowing very well that the independence would get compromised, although it is not in one of the lists of the section 144. So if the auditor knows that his independence will be compromised by seeking these services or by seeking mandate for these services, I think auditor himself need not go to the board or the audit and risk committee to get the mandate. But that large part of the responsibility is there on the auditor. Now, assuming that he doesn't do it and assuming that he actually goes to the audit and risk committee and tries to get a mandate for providing these services, which compromise his independence, I think he will be not only in the dereliction of duty, but he will be actually violating the Companies Act. Because these provisions are not to be taken by the letter of the law. You have to look at the spirit behind why there is a prohibited non-audit service provision there. So long as anything else which affects your independence is being sought by, I think you can't simply say because the board of directors told me I started rendering these services. That will not fly any longer.
So we should understand that the companies should not be held responsible for this.
No, it's see, you can auditor can turn and say the company is responsible, company can turn and say auditor is responsible. Both of them are contributorily responsible and contributorily negligent in terms of making this situation happen. Now, whose independence is compromised? Is the auditor's independence that gets compromised. To that, if he will be primarily responsible.
Okay, sir. You have quoted in your presentation that CFOs are the owners and auditors are the advisors. This leads to the loss of confidence, but practically for small companies and small audit firms, what is the alternative?
You see, for the small companies, I think you need to make sure that your auditor, is he going to be providing you 100% assurance? That is the question that you need to ask. If it is going to be 100% assurance to be provided to the management, work with the auditor. See, with the most of the data today in the digital space, it is possible to do away with sample audit and actually look at 100% assurance. It is in that realm, whether that is provided by the auditor or any other consultant, I think the managements need to look at getting that 100% assurance. In a sense, let's say, whatever are the responsibilities provided in terms of detail and these 136 guidelines and standards provided to the auditor does his job thoroughly at the micro level. You see, it provides 100% assurance. Now, that is the way to go ahead because in the smaller companies, you may not be able to afford a full-fledged CFO there. I think it's whoever gives you 100% assurance is your friend today. Yes, ma'am.
Thank you, sir. The last question we have, how the fees of the auditors should be estimated, whether the auditors should estimate their fees based on the time to be given and the assets and liabilities to be vouched, or is there any other way?
See, this is one area where I think the tariff is not yet being determined by any regulator when it comes to the fees for the auditors, you see. Therefore, there is no tariff regulation anywhere in the world with respect to auditors. Now, when we talk about a responsibility, you see, where the issue arises today, in my personal view again, is that while you may enter into and execute an engagement letter based on certain fees and certain assumptions and estimates, I think what is critical and important to build in is a professional indemnity insurance within that fees or over and above that fees. You see, the professional indemnity insurance is an element which actually will protect you. Any amount of fees that you're going to ask, the client is going to say, sorry, I can't pay you. The company is not going to come back and negotiate that. I haven't seen any large or small audit firm being too happy about a mandate in terms of fees. You see, they will always say that the fees I receive is much less compared to the risk that I carry. My rewards and risks equations are not right. Actually, the solution lies in looking at a perfect professional indemnity insurance cover there. At least so that you are not out of pocket. Forget about the criminal liability. Insurance will not protect you from criminal liability.
Swati, if I may ask one question to Swati. Somebody has, I think, posed this question.
Sure, sir.
Yeah. So this is regarding, is auditor liable only under section 147 or under section 447 or 448 are also applicable to you?
447 and 448 are also applicable, sir.
Are also applicable.
And the liability, and the liabilities will arise.
Yeah, that's a quite useful one actually. I think considering the topic role responsibilities, it is good to know which are the various sections. Thank you for clarifying this. And yeah, there is one a question which is, I think, a bit general, but relating to this topic. If we can just see whether we can, we can give some sort of, your thinking on that. This is regarding how should an auditor decide between resignation and disclaimer of opinion. It could be very fact specific kind of a thing. But is there something general, couple of guidance or principles we need to bear in mind before deciding resignation or disclaimer of opinion?
No, I didn't get that, sir. You're saying
The question is, how should an auditor decide between resignation as an auditor or giving a disclaimer of opinion?
Sir, I think, thanks for asking that, sir, because I think it's very relevant and important.
Yeah.
You see, quitting from a situation and resigning, you see, is your last resort. You see, you may have qualifications, you may have disclaimers, you may have, because qualifying financial statements is the job of the auditor. So if you come out with, and I know for this for sure, there are various companies on the verge of going into IBC or in the IBC today, where the auditors will provide qualifications, and qualifications can run into a couple of pages on the financial statement. But that's the job of the auditor. You're going to resign only if it becomes impossible for you to perform your duty as the auditor. And I think that is what the law calls upon, whether it is SEBI guidelines that have been coming or whether the rules under the audit rules that prescribe the reasons to be recorded for resignation is where it becomes impossible for you to perform your duty. I think that's the point when you resign. The disclaimers are fine, sir. Qualifications are fine. And I think we all know that there are various qualifications that emerge in any given audit report. The management can deal with those qualifications in their director's report.
Right.
So, but thank you for asking that question, which was very important.
As you said, it's in the present context which you are saying, it's a useful question and a useful answer where actually you have given. Swati, over to you. Yeah.
Thank you, sir.
We have received one more question. What are your thoughts on auditors playing the victim card after a fraud has surfaced? Is it like the police saying that they are the victims after a theft has taken place?
You see, again, the manner in which the fraud gets defined is very important to understand. You see, if I have committed a fraud, let's say, then I make sure that the scheme of fraud is in such a manner that Vidyadarji will not come to know. Because by its nature, the fraud is such that he will not come to. You see, therefore, if somebody is providing a victim's card or not, post facto in a fraud kind of a situation becomes very, very difficult. So you will have to go back in time to understand whether the auditor had a knowledge of this fraud or not. Or in the normal course, if the information and the data and material is given to him, he would have unearthed this fraud. So duty of care, duty of extra care would have led to his unearthing this fraud. And that becomes an important element while considering whether post facto he should be, he's a fall guy, he's a victim, or he's an accomplice, or he is main accused. That's what.
Thank you, sir. I think you have set the stage for the next session now.
No, next session is going to be very, very interesting and important. Thanks a lot, Vidyaji. I think it's one of the most interesting elements of corporate world today. I must say thank you to all of you. Thanks to the audience. Thank you for patiently listening to me and trying to kind of understand the views that I presented. Thank you very much.
Thank you very much, sir, for your enlightening session on the role and responsibilities of the auditors under the Companies Act. The 360-degree view of the role of auditors in Companies Act in a single slide and followed by your detailed explanation has clarified the issue as a whole. Now, it is time for our second technical session, and the topic is fraud in a financial statement audit. This topic assumes great importance in today's time of surging financial frauds across industry segments. To enlighten all of us on this topic today, we have Ms. Vidya Rajarao, an expert in the field of fraud examination in the country. Ms. Rajarao is a chartered accountant from ICI and a certified fraud examiner from the Association of Certified Fraud Examiners, USA. She has over 25 years of experience and expertise in numerous forensic accounting assignments, fraud investigations, and regulatory proceedings in India and the United States. Ms. Rajarao is the founder and director of Fraudopedia Private Limited, a startup venture that aims to equip young professionals and stakeholders with tools to prevent, detect, and combat fraud in India. Ms. Rajarao is the member of Technical Advisory Committee of National Financial Reporting Authority. Ma'am, it is my honor to extend the warm welcome to you on behalf of NAFRA. I will now hand over the platform to you.
Thank you. Thank you, Swati. You can present my slides. I will start. It's a very interesting topic. Yeah, so you can just put it in slide mode. Yeah, perfect. Thank you. So let's jump right in and we can go into the next slide. So what I'll cover is the responsibilities of fraud. What is fraud as per Standards on Auditing SA 240? How do you undertake a root cause analysis? What's the role of an auditor? Some key red flags, and I'll conclude with a summary. So it's a heavy agenda. So let's move quickly to the next slide, which gives you a snapshot. And you can see from this slide, it's a very small snapshot, but nonetheless tells the story of fraud across India and the globe. So there are only 2 points from this slide: that fraud is ubiquitous, fraud is evolving, and fraud spares no one. So as fraud evolved, standards to combat fraud have also evolved. Next slide, please. So what is the responsibility for detecting fraud in India? So the first responsibility and the primary responsibility for preventing and detecting fraud rests with those that are charged with governance, which is the board of directors and the management of the entity. The auditor's responsibility regarding fraud in an audit of financial statements is as follows, and it's primarily derived from Section 143 of the Companies Act, read with the ICAI Standards Auditing SA 240. So the auditor is responsible for obtaining reasonable assurance that the financial statements taken as a whole are free from material misstatement, whether the material misstatement is caused by fraud or error. So the distinction is important in determining whether it is fraud or error, and we'll see what is the distinction which differentiates fraud from error. Next slide, please. So what is the definition of fraud? It's actually a very simple definition, and perhaps the simplest definition I have seen of fraud among all standards and legislation. Fraud is an intentional act. So intent is key, by one or more individuals among management, those charged with governance, for example, the board, employees, third parties. And it involves the use of deception, to obtain an unjust or illegal advantage. So the key elements are intent by individuals either acting alone or jointly, and involving deception, because deception is the key indicia of fraud combined with intent so that detection can be delayed or hindered so that continue. So the auditor, in summary, is concerned with fraud which causes a material misstatement resulting from two aspects: fraudulent financial reporting, which are likely to be perpetrated by either management or those charged with governance or both, as well as misstatements resulting from misappropriation of assets committed by employees either acting alone or jointly with third parties. So the underlying action which differentiates fraud from error is intent to deceive or to obtain an unjust or illegal advantage. So determining intent is the critical aspect in fraud and fraud investigation. Next slide. So if you look at a very sample and a very simplistic portrayal of what is a fraud tree, there are much more elaborate versions of this, but I think for the purpose of this presentation, I've simplified it. So if you look at fraudulent financial reporting, it covers three aspects: intentional misrepresentation, either by omission or commission; manipulation, falsification, including forgery and alteration, so window dressing of financial statements; as well as intentional misapplication of accounting principles, because the first principle is the selection of an appropriate accounting principle. So if that judgment is misapplied, so you will end up with fraudulent financial reporting. In terms of asset misappropriation, you can look at asset misappropriation, which is asset misappropriation is simply put theft or embezzlement or stealing. It's stealing or theft of cash and cash receipts, including larceny, theft of sales, receivables, and refunds, as well as fraudulent disbursement schemes like billing schemes, payroll schemes, expense reimbursements, as well as theft of inventory or other assets. Why is asset misappropriation relevant in the context of financial statement audit? It is relevant because in almost all cases, asset misappropriation is accompanied by false or misleading records or documents to conceal the fact that the assets are being misused, or they're missing, or they have been pledged without proper authorization. So one of the first indicators of fraud in an entity, which an auditor may likely come across, but perhaps may not pay that much of attention given the immaterial nature of fraud, is asset misappropriation. Because asset misappropriation or embezzlement, the value of fraud is very small as compared to financial statement fraud, but the volume is high. Whereas in contrast, financial statement fraud occurs relatively infrequently, but the value of such fraud is high. Next slide, please. So one of the primary tools forensic investigators use, and auditors can actually use this tool quite usefully, is known as the fraud triangle. The fraud triangle has stood the test of time. It was created by Donald Cressy, an American criminologist, in 1953, and he coined the hypothesis which we all now discuss as fraud triangle. So Donald Cressy essentially wrote a book called Other People's Money, and in that he outlined that why do people commit fraud? He asked the question, and his answer was there are at least three factors which motivate someone to commit fraud. First is a pressure or an incentive to commit fraud. Second is the opportunity, which is the knowledge and the ability to carry out fraud. And third is, as human beings, we need a rationalization of our dishonest action. So we need to be able to rationalize to ourselves as human beings that we are actually not committing fraud. So if I give you a simple example, an employee who is stealing money from the company by submitting false receipts, false claims for expense reimbursement. The motivation could be, or an incentive or a pressure could be he's got family pressures. There are immediate pressures on money. There's say excessive lifestyle. There's a health issue in the family. He's short of funds for a certain point in time. The opportunity comes from his position in the company, his role in the company. He's a trusted employee. He has the means because he has access to certain records, or he knows that the controls within the company are weak. So in other words, that the controls which the company has around monitoring expenses are either ineffective or weak, and the employee is aware that if a receipt is submitted for a fictitious expense or a receipt is submitted for a higher amount, the company's controls will not detect it. So he's aware of that knowledge. Third, the rationalization comes in the form of it is only a short-term requirement. I intend to pay it back. So if I'm going to pay it back next month, I will claim less. This month I claim more as expenses. So I'm not stealing. Or everybody else is doing it. Everyone in the company is, or in their group or this group of employees, everyone is submitting a receipt for a higher amount or a false receipt, and the company tolerates and they're not getting caught. So there is somehow seen as a tacit approval of this kind of behavior, and the company is tolerating what's known as petty theft. So the employee is able to rationalize the action as not dishonest, and that's critical as human beings. And these three put together is known as the fraud triangle. So the next slide, we look at financial statement fraud. What are some incentives or pressures? So in the next couple of slides, I'll give you some indicators of pressure, the fraud triangle for financial statement fraud and the fraud triangle for asset misappropriation. So some of the risk factors in terms of the incentive or pressure is a very high degree of market competition or market saturation, which puts pressure on a company to meet its earnings forecast, its EBITDA numbers, its earnings per share targets, which invariably will link with compensation to management. There's vulnerability to rapid changes, so high rate of technological obsolescence, again putting pressure on earnings. Significant decline in customer demand, and there are increasing bankruptcies, whether it's in the same industry or the company itself is facing significant threats to its working capital and is a target of an acquisition or a hostile takeover. The company's performance itself is under threat. There are negative cash flows, and there are some new accounting regulations or sometimes new regulations which question the existence of the business itself. So these are pressures and or incentives for management to ensure that they appear different from the industry, or they appear as safe spots, so to speak, amidst economic uncertainty. So if you look at the opportunity in the next slide for financial statement fraud, it comes from the ability to dictate terms, an over-dominant position. It can be over-dominant position of the company as well as an over-dominant CEO or an over-dominant management executive in a C-suite, significant related party transactions, which are not in the ordinary course of business. And we've all seen enough cases of related party transactions which have come under the scanner in the last 3-4 years. And the rules regarding related party transactions continue to be tightened by SEBI. Items in the financial statement, whether it's assets, liabilities, revenues, or expenses, they're based on significant estimates, which involve significant judgment and uncertainties, which are very difficult to cooperate. So it provides an opportunity again for choosing optimistic estimates of impairment, for example, impairment of assets, certain derivatives or foreign hedging, certain transactions which are highly unusual or complex, especially during a period end, and there are very difficult questions on substance over form, and that's the first indicator, because there is a lot of documentation, unnecessary layering, unnecessary structure. Usually there's a web of corporate structure, and one struggles to understand the economic rationale of a transaction. And bank accounts or subsidiaries in, say, tax haven or opaque jurisdictions. So these are opportunities for management and those charged with governance to commit financial statement fraud. In terms of attitudes or rationalizations in the next slide. So some of the examples are where the company has a known history of violation of securities laws or other laws and regulations. There is excessive interest by management. So these are more behavioral traits to dictate the entity's earnings, inventory, or price. The management failing to remedy known significant deficiencies in internal control on a timely basis. There's an interest in employing inappropriate means to manipulate earnings. There's no distinction made between personal and business transactions or personal and corporate assets. And this is a critical aspect in India, because a lot of companies are promoter-driven, highly influenced and led by a promoter group. Not that there's anything necessarily wrong with it, but there's always a question of a distinction between what belongs to the promoter family versus what belongs to the company. That distinction gets blurred many times, and that poses friction. And the last trait is relationship between management and either the current auditor or the predecessor auditor. And we are seeing a precipice of that, like in the last slide, where I think Mr. Kulkarni asked a question on auditor resignations. Perhaps that's a result, I don't know if it's symptomatic of this frictional relationship between management and the auditors, that auditors are perhaps choosing to resign and not disclaim an opinion. That perhaps may be symptomatic of it. If we now look at asset misappropriation, what are some fraud risk factors? Primarily, these are personal financial obligations of individuals who have access to assets in the company or cash in the company, or adverse relationships which motivates employees to misappropriate assets. For example, adverse relationships are created by anticipated employee layoffs, or there are known layoffs in a particular segment or division or industry. There are anticipated changes to, say, employee compensation or benefit plans, and promotions and rewards are inconsistent with expectations. So one of the common reasons we hear when we investigate types of theft on asset misappropriation is the employee feels entitled to a certain level of bonus, and the bonus is not announced. They believe they're taking what is legitimately due to them by submitting false receipts and false expenses. So it's one of the key factors in asset misappropriation cases. In terms of opportunity, in the next slide for fraud risk factors, the opportunities again primarily stems from controls within the organization or the lack of controls. So there are large amounts of cash on hand, inventory items are small, the high value in high demand, so it's easy to steal or embezzle. The easily convertible assets like bearer bonds or computer chips, and nowadays it's data, fixed assets which are small or marketable, and inadequate internal control over assets. If you look at the rationalization, it's the disregard for internal controls and taking advantage of or overriding existing controls. Behavioral traits like displeasure or dissatisfaction in treatment, changes in behavior or lifestyle where the employee's monetary needs have exceeded what the employee currently makes. And the last is very important, is a cultural attribute of tolerance of petty theft by the organization. So I think companies talk about culture, ethics, tone at the top, code of conduct. If those remain on paper and there is no action taken for small violations, or the action taken is random or inconsistent based on who has committed the fraud, and if action is not taken, if someone close to a CEO or close to the family, close to the promoter group is seen as getting away with fraud, that leads to erosion of culture. And ultimately, culture comes down to what you tolerate. And that's a very critical aspect in the fraud triangle between incentives, opportunity, and rationalization. Next, please. So let's now look at what is the role of an auditor in considering fraud in a financial statement audit. So first is skepticism. I think all of us as auditors are generally skeptic, but over time, we tend to believe that management is honest and we trust management, and that's the bedrock of conducting an audit. But one in these days has to be not satisfied with less than persuasive evidence and needs to be alert to conflicting evidence that one has obtained during the course of an audit. Second, pre-audit discussions are critical, where one needs to brainstorm with the audit engagement team on possible fraud risks pertaining to the audit client. And it is important that at this session, you set aside any prior association you have with the client and assume absence of internal control, or assume what would be a scenario if there is management override of controls. So what we see very often is these pre-audit discussions are very routine. They're not conducted with the rigor that one needs to apply. And inevitably, the partner or the senior person on the audit team will attend the meeting and start the discussion with, well, we know this audit client for 10 years, 6 years, 5 years. So-and-so audit, this company is very well respected by the investor community. They have a very good code of conduct. They have excellent ethics. They have a good board. So you start with that assumption. So the rest of the engagement team and the rest of the discussion never ventures into, is fraud possible at that company? So today one needs to ask the question, is it possible for a fraud to occur at the company? Irrespective of who's leading the company, who's at the board of the company, and at what point in time will that fraud be discovered? Will it be prevented before it occurs? Or will it only be detected? And what is the lag in detection? Will you detect it after 10 days, after the audit is over, after 2 years, or it is reported in social media? What is the time period for detection? So one needs to ask that question, and you will have to set aside prior associations and assume either an absence of internal control or assume management override of internal control. The second is again critical, is to use the fraud triangle. The fraud triangle is a very powerful tool, and it's a simple tool. It's not complicated. You can use the fraud triangle to develop your audit procedures. You can use your fraud triangle to conduct data analytics. You can build your rules and algorithms today with data using the fraud triangle. So think of what could be the incentive, what is the opportunity, what is the culture or environment for that company in comparison with the industry, the pressures in that particular industry, whether it's a high rate of technological obsolescence, or there is rapid evolving regulatory change, or there is significant pressure on pricing. There are very few vendors, reliance on very few vendors, and over-reliance on certain customers. Employee dissatisfaction, high rate of turnover or attrition in key functions, supply chain issues. So the auditor has this information. They just need to map it to the fraud triangle and use the fraud triangle throughout the audit, both in planning, test, and in evaluating the results. Next slide. So discussions with the management or appointing authority. This is again critical that auditors must have a discussion with the audit committee and with management on what is their view on fraud risks. How do they plan to address fraud risks? It cannot be enterprise risk management. It cannot be, the answer cannot be, we have a very robust ERM. That unfortunately is not the answer. We all know everyone has a system, everyone has IT, everyone has ERM, but that's not the answer to the question on what specific fraud risks is the company worried about and how are they going to address the fraud risks. Whether they have any knowledge of any fraud or suspected fraud. Again, the answer cannot be we have a very strong whistleblower hotline and no one has reported any fraud. To me, that's a significant red flag, that if you have a whistleblower hotline and no one's using it, that's because people don't have confidence in that hotline. Maybe they're reporting it through the grapevine, it's coming through various other informal channels. What is management's understanding about risk of fraud? Because remember, the primary responsibility of fraud first lies with management and those charged with governance. What are the controls that the entity has to establish and mitigate specific fraud risks? How do these controls deter fraud? Do they detect fraud? How do they monitor it? And how do they communicate to employees what are their business practices, what is meant by ethical behavior, and how do they monitor such behavior? Next slide. Again, separate discussions with the audit committee about their risk of fraud, like I mentioned earlier. So the earlier slide was with management, with internal audit also, because internal audit is the first line of defense on their views of fraud and whether internal audit undertakes any procedures in terms of fraud risks, and others. So go beyond just the finance function. Speak to in-house legal counsel, you speak to human resources. These days, it's very critical to speak to IT, because information technology and information system is pervasive. So you will need to speak to someone who's in charge of technology, chief technology officer, maybe there's a data security, some may have an ombudsperson. So you'll need to speak to multiple people outside your finance channel, and use it as an opportunity to get information that the auditor, who will otherwise may not receive such information. Next, please. So correlate all these responses, evaluate if there are inconsistencies. When you conduct your audit procedures, analytical procedures, again, like I said, use the fraud triangle. It's a very powerful tool, and over time, auditors can become quite experienced and experts at it. Consider the fraud risk during both vouching and transaction. Assess not just the risk, but evaluate what is the type of risk, what's the significance, what's the likelihood of occurrence, and how pervasive it is. Re-evaluate this prior to closing the audit. So have you found new fraud risk factors or fraud risks during the audit which differs from what you identified during planning, or vice versa? And use subject matter experts. So no audit team today is alone. Every auditor has access to a forensic specialist, whether it's in-house or external. You can use them at least to help you in designing the fraud triangle, evaluating the results, and suggest some procedures, or even to conduct training to the audit teams on the evolving risk of fraud. Because many members in the audit engagement team are aware of these fraud risks, but they're just unable to articulate or put it together in a very cohesive form. So you can use that. In terms of key red flags, there are three main categories: discrepancies in the accounting records, conflicting or missing evidence, and cultural attributes. So some of the key red flags I've listed, I'll not go through all of them in the interest of time, but some of them are, last minute adjustments which affect financial results, unexplained items on reconciliations, access to systems and IT which are inconsistent with their duties. It's a very critical aspect today in a digital world. Documents which are mysteriously lost. Original documents are lost. So one of the common complaints we receive is they were lost in a flood. You know, there was this Mumbai flood some 10 years ago, so our documents are lost. Or there was a massive fire. We lost all the documents. Some of the documents appear to be fabricated or they're altered. Electronic data, integrity of electronic data is questionable or it appears to have been tampered. You see evidence of editable format of invoices and purchase orders of third parties on the systems of employees. You're denied access. You know, IT audit access is denied to certain facilities or access to employees or customers, and undue time pressure on the audit team to resolve complex or contentious issues. Go to the next slide. Unwillingness by management to either add or refine disclosures in the financial statements. Unwillingness, like I said earlier, to correct deficiencies in internal controls. Frequent changes in accounting estimates, which do not appear to result from underlying business circumstances, and tolerating violations to the entity's code of conduct. So these are again some of the key red flags. Next slide. Yeah. So this is really my last slide, and I just want to leave it with, I didn't want to do the top 10. Seems a cliche, but I'll just leave you with the basics. All of us will know and all of us agree that external audit is not an investigation. An audit is different from an investigation. So are auditors. Auditors are not investigators. So if you're in doubt, you always engage a specialist, whether it's in-house or external, who then can help you navigate the risk of fraud in the company. Similarly, the methodology that you use for audit cannot be the same as one you use for investigation. It's a challenge that auditors must navigate, since considering fraud in a financial statement audit is a mandatory requirement. So the key to that is to train the team. The junior most team member generally gets the micro details of the company that they're auditing, whereas the partner may have a macro picture. So you need to train everyone in the audit team to be aware of fraud risks. Be objective. You exercise caution, you do your due diligence, and just look beyond the questionnaire or checklist. Today, audits become more of a checklist or a questionnaire, whether it's in paper or digital format, so you have to look beyond the checklist. The most critical aspect is change the mindset. You still trust, but you must verify, because that's your obligation. You link your audit findings, again, going back to the fraud triangle. I cannot emphasize enough the use of the fraud triangle. Embrace technology and analytics. Traditional procedures, traditional audit procedures, or even investigating procedures seldom will detect fraud these days, because fraud schemes have become more complex and fraudsters are far more sophisticated. They're always maybe 10 steps ahead of the game. Remember that your work paper, all audit work papers, must stand the test of law and the minds of the regulator. So many times we've seen that auditors will claim that they did the testing and they discovered the issue, but there is no evidence of it in any of the audit documentation. The last point is, when you're in doubt whether it is an error or fraud, establishing the intent is key. What was the intent of that person who committed this error? So intent can only be derived through an investigation, and a proper investigation will require specialists, and the audit team will not be fully equipped to determine intent when they're already burdened with completing the audit under time pressure. I think that's all I have. I think that's my last slide. Is there a next slide? I don't think so. Yeah, so that's just questions or comments. Happy to take any and all questions. Thank you for your time.
Thank you so much, ma'am. We have received a few questions from the audience. I will read out the questions to you so that you can answer. And the first question we have received is, What are the specific audit procedures that should be performed by the auditor for detection of fraud related to undisclosed liabilities?
Relating to undisclosed liabilities. Okay. See, I think it's very difficult to generalize the procedures in a vacuum. So one will need to know more about undisclosed liabilities. Are you talking about contingent liabilities? You're talking about prior period items. You're talking about liabilities in terms of borrowings, in terms of pledged collateral, in terms of what liabilities stated at fair value. So it depends on what is the nature of the liability. And I would say one is, there are 3-4 things you can do. One is, of course, undertake your analytical reviews. You compare with industry. You take a very critical look at the cash flows, the working capital position of the company. How is the company generating cash? How is that cash being used? And then you look at the capitalization, and you look at assets and liabilities, and whether there's a mismatch in use of capital for either short-term or long-term assets. You will also need to have discussions with beyond someone in the finance team, maybe treasury, maybe there is someone who's handling relationships with lenders, even the legal team, for example, certain contracts which exist. So you can have a look at the contracts which the company has and see if any of those contracts result in liabilities that have not been recorded on the books. So those are some of the things I would suggest.
Thank you, ma'am. The next question we have received is, how can the audit committee or board of directors of a company identify the transactions executed by the key employees on behalf of company without proper authorizations with an intent to defraud the company?
Can you repeat the question? So how can the audit committee and the board of directors
identify the transactions executed by the key employees without proper authorizations with the intent to defraud the company?
Okay. Yeah. So some of the ways to do it is, one is having a very strong internal audit function, right? So you look at internal audit as the primary line of defense and have internal audit verify transactions which key employees and management have undertaken, and then evaluate whether those were transacted properly as authorized by the board. So many times the audit committee and the board, there is also a management committee. So there's a finance committee, and you will have to evaluate whether the internal finance committee comprised of management has exceeded the remit given to it by the audit committee. Evaluate, you can have discussions with third parties. So the best way is to look at third parties, whether it is on a sample basis, you look at vendor transactions, you look at customer contracts, you look at lender agreements. And if there are agreements which are then determined to be conducted without proper authorization. Third is, use, again, the IT function. So you look at their roles and responsibilities in the system in IT, and then evaluate if there are transactions which they have committed the organization, but that's beyond their remit. And then you will have to do a proper investigation to figure out intent, which means you have to go through emails, you may have to go through their phone records, you may have to do what's known as a background check, hire specialists to undertake a background check and a lifestyle check. So you'll have to do, investigative procedures to identify whether there was any intent.
Thank you, ma'am. The next question I'll read out is, do you foresee digitalization as a threat or strength for identification of frauds by auditor?
I think it's both a threat and a strength. The auditor can certainly use it as a strength. Today with digitization, a lot of the accounting records, a lot of the accounting data is digital. So if you have the right tools, you can then spend more time evaluating the results of your analytics rather than conducting the analytics, because it takes a long time to do an analytics in a non-digital platform. But unfortunately, the threat comes from the inability to verify whether the transactions are genuine. So you don't know whether the data that you're given is complete, whether the data that you've given is correct. So you will need to first evaluate those control aspects. So for example, there was, I think recently it was reported, there was a company which had a fictitious branch. They created a fictitious branch and they were taking deposits and then they had loans. So the entire branch was fictitious. It was purely virtual. But on paper, it looked like the branch existed, but the branch existed only in the system. There were no customers, no vendors, and they had a bank account. So money was getting siphoned from this virtual branch. And as auditors, we all know of the second set of books of accounts, right? Because those are never on the books. So the threat comes from evaluating the strength of the data. How can you be sure that the data that's given to you is correct? What is the integrity of the data? And the person who's extracting the data, how do you know that they've not extracted it by omitting certain errors, certain rows and columns, or they have inserted. So another fraud which we've seen recently is in sales and debtors. The company has millions of transactions of sales in a quarter. And usually we all know last week is a crazy week and, you do the cutoff procedures. So last week of any quarter or year end, there are unusually large number of transactions. And someone in the accounts function had inserted fictitious sales. Of course, they knew which ones were fictitious because, they had kept a small change in the way the invoice numbering was done. So they knew because they could remove it. And we all know as accountants, you have to reverse it next year, right? So accounting is not, unlike asset misappropriation, when you do financial statement fraud, you have to rectify it. You cannot continue. So they had inserted rows, randomly in the Excel. They would take a data dump from SAP or Oracle or whatever ERP, insert rows with fictitious transactions, and then give it to the auditor. So how do you know that the data that you've given is not tampered with? I think that's the threat from digital transactions. So the auditor will then have to evaluate the integrity of the IT systems. And these days, every capacity is not an issue, in terms of handling gigabytes of data. Processing data is not an issue because everyone has access to that technology and it's quite free. It may not be the audit team, but in most firms, you get the software these days at fairly nominal rates, or outside the audit teams, audit firms have a business of analyzing data. They have their whole big data tech specialist. So you can use that team to take a data dump instead of taking reports and extracts. And then you run some simple validation checks on the data before you run your analytics.
Thank you, ma'am. Another question is, as per your opinion, whether frequent changes to audit engagement team dilutes the audit quality or improves it?
Well, that's a subjective question. It really leaves, I leave it to the engagement team and the engagement partner to decide it. But I am a firm believer that it's always good to have new blood and new thinking because we all know familiarity breeds contempt, right? So I'm a believer that you should always have some rotation of the audit team so you get some fresh perspective, fresh insights, even rotating someone from one sector. Today there are, because of the complexity of businesses, everyone wants a specialist, right? So if you're auditing telecom, you want someone who understands the telecom industry, who understands the jargon in the telecom industry, ARPU and net revenue and tariff and same thing with power generation or retail, even e-commerce. E-commerce, for all its simplicity, has so many technicalities in when do you recognize revenue. So everyone prefers, as a partner, everyone, one would have a natural preference for having an audit team which has worked on the client for some number of years, so that there is, again, goes back to, like the earlier speaker was saying, managing cost and managing risk in relation to the fees. But my view is some proportion left to the professional judgment of the auditors. You need not have 100% rotation, but having some proportion, 1/3 of your staff rotate. So someone comes with a telecom background into e-commerce audits, and someone from e-commerce goes to power generation. Keeps the team fresh. It's a very good tool for motivating auditors. And they may have some fresh insights. The way they have audited revenue in telecom, they may have some insights which you can use in your client, which is in retail or e-commerce or, industrial manufacturing. Beyond that, I can't really advise.
Sure, ma'am. There is another advice needed. Can you give some key inputs on what specific training should be given to the junior most members in the team, article assistants, especially for fraud-related procedures?
Yes. So I think one should not ignore the article assistants. I mean, I think it serves multiple purposes, right? I mean, today the profession of CA is facing several challenges. Firms, when I speak with, are not getting enough article assistants. Many of them don't want to become a CA. It's as it is difficult to pass the CA, and if we make it even more difficult to them while learning on the audit, it's very difficult. So if you can give them training, and the articled assistants, and let's be honest that they are the digital generation. They're the 21st century. They'll be able to spot a fraud far faster than I can. I grew up without the internet. The article generation has not seen a day, or they haven't seen a second without a mobile phone. They can very quickly find information on social media, on various chat rooms, which I don't even know exist, where someone in their company, which the auditor is auditing, is complaining about the auditor or is complaining about someone else. So the youngsters have access to information much faster than a partner may do. So you just need to channel that information in the right direction. And one way to do that is to give them the training. And you give them the training and do a basic training. They don't need to become specialists, but alert them to the fact that fraud can happen at any client at any time. No industry is immune. No one is immune from this across the world. It has happened to the best of companies. So one needs to be aware of fraud, and it's a significant risk for the audit team, and train them on, say, the fraud triangle. What is the fraud triangle? And ask them to come up with some incentives or pressures. What could be the opportunity? What are the controls? What controls do not exist? What could be some of the rationalization? So even if you train them just on the fraud triangle and help them to use the fraud triangle when they go to the client, and then, of course, sensitize them that they can't overuse it, or, go and ask audit CFOs, you can't, the article assistant cannot go and ask the CFO, I think this is your motivation, or in my fraud triangle, it says X, so you must be doing X. So you can sanitize them on the communication, but giving them the basics of the fraud triangle and what are some red flags and how to identify them. That is one of the most basic level of fraud training. And you can add in, once that's done, you can add in some industry specific fraud risks.
Thank you, ma'am. Can you discuss the use of prior period errors as evidence of fraud? Has a change in reporting of these items post-index retroactive restatement changed the incidence of these errors?
So again, the question comes down to determining intent, right? So prior period errors, if they remain errors as defined in the standards, will not qualify or rise to the level of the nature of fraud. But a restatement necessarily comes from inaccurate reporting, whether it's due to fraud or errors which are of such a great magnitude or volume that one questions the intent behind the errors, right? So errors by their very nature are mistakes. So they're one-off. So you cannot have an error every quarter in every account balance and then claim there was no intent. It's very difficult to pass the smell test of an error. If you say that you've made an error in a bank reconciliation or in a current asset balance, or you've calculated working capital incorrectly every quarter and every month. So it's very difficult to say that there was no intent behind it. And a restatement clearly crosses the threshold of an error. So it again all comes down to intent between error and fraud.
Thank you, ma'am. The last question we have for the day is, are there any specific set of people in the company other than those charged with governance and senior management with whom the senior audit team member should make fraud inquiries with?
I mean, I would suggest, that's a great starting point. You do it with both those charged with governance and with management. But if you have trained your audit team, articled assistants, etc., junior members of the team about the fraud triangle, they are not necessarily interacting with the C-suite executives. They may be interacting with a division head, or it's a division controller, or it's an accounts assistant. So a junior member of the team, if they're well trained, can also have discussions with junior members in the finance team about fraud risks. So it's a normal question, which, because it's already part of your audit procedures, you then have a great opportunity to then find out if the what they call in forensic specialists love these acronyms, so they call it mood in the middle, like tone at the top, they say mood in the middle, the accounting department. So you can have junior members of the team, audit team, have discussions about fraud risks with mid-level, junior level accounting function staff in the accounting department, supply chain, in procurement, can be in stores, someone who's managing inventory, someone who's handling treasury and operations. So those discussions can happen as long as your audit team is trained and your audit plans are aligned with the fraud triangle. I think you're on mute, Swati.
I'm so sorry.
No problem.
Thank you so much, ma'am. This was the last question for the day. And I'm really thankful for your session on the fraud in a financial statement audit. You have beautifully weaved together all the aspects of fraud in financial statement, right from why a fraud is committed, how it is committed, and what is to be done. I'm sure the fraud triangle you have talked about can be a powerful tool for detection of frauds in the financial statement. Now, I request Shri Arun Kumar AS, Chief General Manager in AKAM, to propose a formal vote of thanks.
Thank you.
Thank you.
Thank you, Swati. Respected Executive Director NAFRA, eminent speakers for the day, distinguished guests, ladies and gentlemen, good evening to all of you. We had two fruitful, engaging and memorable sessions today. That makes me privileged to propose the vote of thanks now. First of all, I would like to thank each one of you for sparing your valuable time in participating in this webinar. It is very encouraging to see such an active participation of a large audience. On behalf of NAFRA and on behalf of all those who participated in this webinar, I extend our heartfelt thanks to our eminent speakers, Madam Vidya Rajarao and Sri Suhas Tuljapurkar. As TAC member and as expert speakers of the day, your contributions to NAFRA are invaluable. Thank you, Madam Vidya Rajarao, and thank you, Sri Suhas ji. I extend my sincere thanks to Executive Director NAFRA, Sri Ragesh Banerjee, for his encouraging opening remarks, Madam Swati Singla for her excellent coordination, and I also thank all the staff members of NAFRA, NIC, and MCA who made this event possible. Thank you again and have a nice evening. We will call it a day.